Welcome to the Capital Discussions Market Analysis. I'm Tom Menamaker with Jim Riggio and Ian Scott in the background here. Before we get started, we have a disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations, and the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. Actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So now we've got that out of the way. Jim, I know you're highly interested in Apple, so you told me you did have an Apple trade on. Did you want to go over that a little bit?
Sure, we definitely will, but I figure let's stick with our normal. I'd like to start and go over the technical analysis real quick because there's some really interesting things that are going on right now.
Sure, you've got the ball.
Okay. What I'm sharing with you right now is my technical charts on the S&P 500. You can see that it goes back about a year. Wanted to focusing on what's really been going on over the last, month and a half, 2 months or so. You can see that the sell-off was quite substantial. If you remember the lines that we talked about, Tom, the orange line was the 100. I think we were looking, remember I told you we were looking at the 150 when we ended up breaking it? And then we broke the 200, right, which is the red line.
Right. Yeah, there was a post in our forum that Mark Hulbert said once it broke that 200, it was time to buy. It looks like he might have been right.
He was a week or so early. Okay, and it's at least right now because we're only back once we broke the 200. You can see that today we got back up to the 200. For those of you who are IBD fans, I kind of really like their opinion on when is a bear market over, when is it too early. And their opinion is you must be 4 days past the bottom. We are 1, 2, 3. Okay, you must be 4 days past the bottom. On the 4th day, it would count, and you must be up, hopefully significantly on higher volume. Okay. When we take a look at the overall volume, the volume was lighter today than it was on Friday. So, I mean, Friday was an up day, today's an up day, but today wouldn't count as an accumulation day. They want an accumulation day, an up day on higher volume on the 4th day. So, for what it's worth, they have been accurate over the last 100 years or however long they've been in business, when Bill O'Neill started his analysis in 1842 or whenever he did it. So we definitely have come a long way off the bottom. You can end up seeing that basically every one of the oscillators, the MACD, right, the MACDs here, the stochastics, the RSIs, the Williams percent R, the TCIs, they've all turned up. And they've turned up, okay, a couple of days ago, basically, upon hitting our bottom as we started to end up rolling. I think that we're in an absolutely critical point on this. I can end up also showing you real quick. I know a lot of people trade the RUT. The RUT, okay, just a quick comment. The RUT over the last couple of years had been leading us up and now had been leading us down over the last couple of months. You can see it wasn't just recently that the RUT started to sell up. They started to sell off quite a bit earlier. But we've also come up to, while we haven't gotten up to our 200-day moving average, the good sign is that we've sold off so much that while we had, this 20-day crossing the 200, we now have come back up to our 20-day, which you can see that we've struggled with now for a month. So they too are positive. The MACD, everything has turned positive. Here, these turned positive a little bit earlier. This is the 4th day, right? I'm sorry. This is also the 3rd day on it running up. The last thing I just wanted to say that we were in a really critical point was that when we take a look at the volatilities. Now, I had shared this, okay, with everybody. And this was the volatility indicator that I ended up showing, okay, do you get long the VXX? And we ended up getting long on this day. It ended up showing, but we started to turn back down. Each of these lines, just to refresh everybody's memory, the green line is the 2-month minus the 1-month VIX contango backwardation line. Below 0 is backwardation. Above it is contango. You can end up seeing, and the yellow is the 2 months minus the 3, and then the red is the 3 months minus the 2. So therefore, for those people who like to look at VIX Central, I always look at this. The pink line, which I don't put a lot of credence in, is the cash. The cash, okay, had been way above even the 1 month. You can see things have started to come back in line right now, and you can end up seeing that we look like we're getting ready to end up crossing on the longer term volatility line on the R-vol indicator that I ended up building. So, all in all, I'd say that, we were at a pretty critical point today. The rally was quite substantial, and because we are at these critical levels right now, we thought that Apple would have a huge impact on the direction of the market, being the largest market cap. Is it the largest market cap or GE? Okay. I know that it beat GE a while ago, and I didn't think it ever came back. Anyway, so when I ended up taking a look at that, one of the things we took a look at is what was going on with Apple. You're looking at a 1-minute chart here of Apple, just with some of the earnings. You can see that we moved up, not significantly though. We ended up putting on a trade on Apple that I thought I'd end up sharing. And that trade on Apple was as follows. You can over here. We started, let me say how we ended up taking a look at this. The first thing we ended up looking at was what the implied volatilities look like. Okay, and what the implied volatilities ended up looking like, and I'm on a different PC, so I don't have my live vol open. It'll take me a minute. But what we ended up taking a look at is that the calls were relatively cheap. The at-the-money strangle was relatively cheap. And when we went out, there was a typical pattern that Apple ends up having many, many times in its volatility. And let me end up showing that to you. Okay, here we go. Here's the skew curve on Apple. So what happens many times in the front month is that you actually get a bump higher, okay, at the money, and then you almost get this like W type of shape. It's a little bit rigid right now because of the end-of-day pricing. But what we found is that there was a little bit higher vol here. You got into lower pieces down here on both sides. The average move was a little over 5% over the last 8 quarters for Apple to end up moving. For those of you who don't end up using it, we used to end up going off of Bloomberg, but Tom's tool, let me end up putting this over here, that he put together is, basically all of the same information that we used to use Bloomberg for, and actually a little bit more. If I end up showing you the resources, I'm sorry.
You got to click on login.
I was like, where is it, Tom? How come it's not there?
Yeah,
Tools,
there you go.
earnings. Okay, 34. So, here was the 5.7% it had moved. It was interesting that most of the move was a gap. When we move significantly, okay, and this is stuff that we don't get off of Bloomberg. We go to this tool for it. When it moved significantly, it had continued to run. if it didn't move very far, okay, it would end up sometimes pulling back or even reversing. Take a look here where we ended up opening up 1.2%, but then ended up reversing at the minus 0.25. So when we take a look at the difference on the average between 5.17 and 5.57, the close to the open versus the close to the close, the reason why it was bigger was mostly because of when we ended up having larger moves, we could continue to run. Obviously, you can see that to the downside more than the upside normally. So having said all of that, what we ended up doing is we said, okay, volatility is being priced in pretty cheap because it was only pricing in less than a 4% move. Now, I kind of thought that it kind of was a little bit strange because if I show you the volatility chart on it, give me 1 second, I'll bring down the volatility chart. Oh, okay, here we go. So I didn't have it in the right place. Okay. If I end up showing you what the volatility chart looked like, you can see that the 30-day IV and the 60-day IV actually came off a little bit going into earnings. Now, it's to be expected with the amount of bounce that we've had, right? But still, it actually gave up volatility going into earnings. So what we wanted to do is we wanted to play for what happens if it does have an outsized move because it's so important. Right? So you see, Tom, any questions about the play and why we were doing this?
No, not yet.
Okay. So if I come back to here, what we end up doing is that earlier in the day, the center of the implied volatility was pushed up a little bit higher, and we were up in the 55, 57 range, okay, in the center. We were up on the call side at the bottom here, at this little cup over here. We're around 53. We also had a little sag, okay, over here. So what we were trying to do is that we were trying to buy lower vols and sell higher vols and still have enough room in case we really ended up moving. Having said that, this was the trade that we ended up putting on. We ended up buying the, it depends on how you look at this. You can say I bought a strangle, sold a wider strangle, or you can do it in back ratios, whatever you prefer. What we did is that we bought the guts, the inside, right? We bought the 95 and the 105, and we sold twice as many of the, the 104s, not the 105, and we sold twice as many 5 points further out. So we sold twice as many of the 90s and twice as many of the 109s. Okay, so we were risking $2,100. We thought if it ended up moving a lot, we might make as much as 10. But we figured that if it ended up running somewhat, the $2,100 really isn't all that much at risk, because if we run up and we get up to the 102, 103 area, we're going to be able to sell out our 104 calls there's still going to be a fair amount of money in them if we start to end up moving. I could sell them out, and so my loss would be mitigated. If we would have run significantly, like got up to 104, 105 now, then we would have kept the trade on a little bit longer to be able to try to end up making as much money in the, the back ratio, the butterfly, or the pyramid, whatever you want to call the area on the right. So that was the logic of the trade. We felt that we were probably realistically only risking, a few $100s to hopefully make a couple of thousand. As it turns out, if I go to the chart right now, we're still at 100, right? So 99 and change. So when I take a look at where we are, our vols are going to get crushed tomorrow. If I end up bringing volatility down, right, and I show volatility, we had done, by the way, again, if I end up coming over to live vol, right, if I come to live vol, I'll show you the earnings tool. you can end up seeing that going from 34 to 24, from 28 to 17, from 30 to 20. And if I go back previous quarters, you get about a 10-point drop in vol. Right? I mean, that was a reasonable estimate. So when I take a look at this, taking myself down 10 vol points at the money, right, because if I, let me come over here, down 10 vol points, I'll do -5 so I can take my steps, right? You know, I might have about an $800, you see the loss right here at the minus, if I go from 29 to 19. You know, my max loss should be around in the $800 range. If we do end up getting any movement, you could see that, you know, if we had run up to the 105, 106, 107 range, those numbers could have been pretty dramatic. So I didn't mind risking the, you know, in our minds, what we were doing is that if we did have a big move, maybe we make 2,000, 2,400. If we don't make any move whatsoever, maybe we lose 800. So it was a way to kind of, now granted, it had to end up moving, but, you know, and it did move. Obviously, that wasn't the case of the people who tried to end up doing this on Netflix. But I thought it was a reasonable risk-reward type of play. We weren't playing direction. We were just playing, you know, some type of movement that didn't happen. Or you know, probably won't happen, right? The trade's not over until Friday, but we're going to end up taking our loss because we don't want to end up risking. We don't want to end up risking the whole $2,100. If I can get out at, you know, $600 tomorrow, you know, I'll be happy. So that was the technical analysis, and that was the Apple trade that we ended up putting on for earnings. And Tom, do you have any questions?
No, it looks like a good trade. Nice risk-reward setup, which is what you're looking for. So, yeah, just too bad it didn't move enough, but good concept.
Yeah. And Dave Stewart actually did the math. He said 3.7% was the implied move. Thanks, Dave. When we took a look at it, yeah, it was just under 4 someplace. I forgot where exactly it was when we were doing it. Just knew that we had about a point and a half of cheaper vol. That's why we were going long the vol, but not crazy with it. I've gone through the total loss on the trade. And he also ended up with, what do I think, what I did, which was very simple. I own 5,500 shares, and I simply sold 55 of the 100 calls for $2. I like that concept. I have been, Dave, I could share an email with you. I have a individual that I speak to that owns more than $20 million worth of Apple, and my suggestion to him was to sell the call, because he's also worried about the downside. And the way the vols ended up working, I would have bought a put vertical on the downside with some of the money that I got for selling the calls. So we would have been a net winner on that today. That was the trade that ended up looking reasonably good. If we take a look at, you know, the at the monies, we're going for around $2. Okay, we could have sold that and bought a, you know, a 5-point wide put spread, probably starting, you know, a little bit higher than where we did. Okay, maybe buying or even buying something like a 3-point put spread. You know, a 98, 95, okay, is what we were looking at before with some of the money. So you know, I kind of liked that trade if I was an owner of Apple. So, yeah, but again, that one I wasn't doing to try to end up making money. I was trying to end up saying, how do I end up both protecting my position and maybe making a couple of dollars because the balls were, you know, where they were. I just didn't want to sell too many of them. Okay. I think that was pretty much. Dave just said that he just ended up gambling that Apple didn't have a lot of downside at this time, and you know it's a reasonable gamble, right? I don't see Apple having a huge sell-off going into Christmas with new products, you know. But, you know, I don't know how much you guys ended up hearing, but when we were talking, their numbers looked good. Their iPhone sales looked great. Their iPad numbers were down. You got it up for the next quarter. And Ian's just telling me they got it up for the next quarter. And let me just pull this up here so you guys can end up seeing. This was just the announcement that they ended up beating. And you can see the numbers right here of what they ended up doing. You know, they beat on iPhone. They really beat on Macs. I was impressed with the Mac number, but that doesn't mean as much to them as the iPhone or the iPad numbers. The iPad numbers, okay, they underperformed. I think that's where the negativity came in from. That they only sold 12.3 million. They were expecting 13, and they did over 14 million last year. But don't forget, they were at the very end of a product cycle.
Yeah, I just got an email today about the new iMac with the 5,000 with the 5K resolution, and just in time for Christmas. So I think iMac sales will start picking up.
Yeah, new iPhone, new iPad in time for Christmas. You know, so you know, was there a ton of downside? That's why, Dave, when you know, for my client who you know, he still, okay, you know, has shivers at night, remembering how much he ended up losing when Apple ended up selling off a year and a half, you know, 2 years ago the way it did. If you take a look at the longer chart. So that's why putting on at least somewhat of a put vertical that was relatively cheap with the I values being lower seems to end up making sense to take a little bit. Now, you know, that's me in a conservative mode for a client. That was pretty much it. You know, one of the things that any questions about technical analysis or Apple or any of the other trades? Anybody get run over by Netflix?
I didn't get run over by Netflix, but the euro and the U.S. markets have really, the average true range has really gotten out of control. So hopefully it'll settle down.
Right. You know, and that, by the way, you know, the average true range, that's exactly what we were doing here in the RVOL, is that we were looking at the average, the moving average of the average true ranges. DXX35. Okay. Yeah. And so that's why, you know, you take a look at this thing, and it had gotten really out of control for a while. The same thing, I don't know if you guys remember, and I did not. I know you guys asked me last week, and I did not end up getting a chance to speak to Dave Walton to share this with you. But if I take a look at the Danger Will Robinson, give me 1 second, I'm pulling it up here. Okay, we've started, not with Apple either, right? Let's go with SPX. Remember what this is saying. This is a great indicator to tell you when the average true ranges start to get large, but it does a terrible job to tell you that, you know, the coast is clear to get back in. Very, very important. So it shall stay up for a while. But what turns around first is you can end up seeing that the implied volatility has really started to end up coming down, right? The implied volatility, and we started then moving. And if I end up coming back over and to show you, I want to show you the VXX. VXX rate, $35. Because the VXX has just been getting absolutely crushed. Let me just get rid of everything here. All right? I mean, you can see what's happened to the BXX, and after hours, it's getting crushed again. You know, so the challenge is that, you know, you end up getting in sometimes of these trades when it gets relatively long. And what's happened is that we're about to go back into contango. Tomorrow, we probably will get back. Were we there at the close, Ian? No, flat. We were flat. Okay, we're just about there right now. So I look at it, and you know, we're not 4 days past the bottom, but you know, it's almost like the volatility seems to go. Now, can it pick back up? Yes. Please be careful. Please be careful in either direction that you trade right now. It's a pretty dangerous market because we can end up moving, as I ended up showing you on where we were at the 200-day moving average. You know, there are very few times in my life when I would have agreed to be a long gamma trader. This is one of them. I just wanted to bring back the oscillators for you. Here's the curves, and you're pretty much flat. You're even contango 1, 2. Right. Now that we've broken the 200, we've come back, we've broken it. One of two things ends up happening, in my opinion. Either the bears come back with a vengeance tomorrow, okay, or the bulls are going to end up trying to establish it as support, right? That 200 will end up acting as either resistance or support. It will end up establishing it. And, excuse me, thank you. And so I think that we will end up getting, you know, in a week or two from now, it wouldn't surprise me if we were trading back up at, you know, 100 spook points higher, 100 spook points lower. Okay. With that, you know, Tom, if there are no other questions, I kind of wanted to share with you, I know a lot of you guys know the guys at Thinkorswim, and Tom Preston, I knew I guess I met Tom in 14 years ago at this point. And when I was first thinking about, you know, doing a lot of work on iron condors and butterflies and what ranges things go in, Tom gave me an assignment. I had to download all of the IBM pricing, and he said, I want you to figure out how much IBM has moved over the last 10, 20, 30, and 40 days. What he was trying to get me to look at is saying, even though it has a reasonable daily, okay, move or an ATR, if you take a look at that in 2, 3, or 4 trading weeks, it gets kind of muted. So I downloaded all of the data. I ended up writing a whole bunch of macros in Excel, and about a week later, I got, you know, some really good ranges that I could end up seeing how far things ended up moving. So this way I had an idea about where I should be placing my short strikes and how I should be trading my iron condor, not based on the implied volatilities, right? That was a whole separate thing that we ended up doing, but based on what I could reasonably expect it would end up moving. Tom, you want to take the ball back?
Sure.
Tom has known this, and has Tom Nunemaker, not Tom Preston, has known this for a while, and he's put together a tool so that you guys don't have to go through the, you know, 3, 4, 5 days of work and then continually updating it to see how much it ends up changing. Tom, you want to walk through what you've done for the folks?
Yeah, so you can see my screen now?
Hang on a second, and I lost my thing, and yes, I can.
Okay, great. All right, so if you go to Tools and Price Movement Analysis, that's what this new tool is. And it took me about a day to figure out the right function to figure out this, where you can do any day of the week. But basically what this is it's using Yahoo prices, which are free. I have the open, close, high, low for each day. And you can pick a range of days that you want to do this on. And I think you said, what, IBM is what you started with, right?
IBM is what we started with.
So you can
In
have
the
this
first
start,
couple of years, how far back can I go, Tom?
well, I think I've got data back to about 2005.
So how about if you give me 2008 to now? You want to give that one a try?
Yeah, we can try it. Kind of in beta, so. So what this does is you can group this in any number of days that you want. So if I just do it with one day, this is like the close from one day, like say Monday, to the close of the next day. And if you run that data, it averages 1.5 points over that range with this standard deviation, and then you can add the standard deviations to the mean and get, however far you want to go, add this to the current price, and there's a good range for your condor for one day. But you can do it for multiple days. So you were doing say like a 20 days. So if we look at this for 20 days, now over each 20-day period, the maximum that it moved in any one 20-day period was $25.15. The average was $6.85, et cetera. And this is the high to low. So you can see what the range was. I think this is intraday. I'll have to check that. But you can also do it for a particular day of the week. So for instance, if you're a weekly options trader, you could do, say, the open on Friday for 3 trade, and these are trading days. So this would be Wednesday, say at the open. And this is all the IBM data. So over a 3-day period, always starting on Friday, IBM moves an average of $2.56 with this standard deviation. So it's a pretty handy tool to do that kind of analysis.
That was the next step. I didn't mention that, but the next step was I had to then end up doing the math to do the standard deviations for 1, 1.5, and 2. Now, Tom, when we do this, are we looking at the ranges? Is this in absolute terms?
Yeah, I mean, like the maximum is from high. I look at the high to low for the range, and then if it's bigger than the previous biggest number, then I make that the new biggest number.
But the average range, 1 point, it's not like it's minus 1 point. That was just the range from the high to low. So that's the absolute range, right? I'm never going to see on the average range a minus number.
Correct. Yeah, that's all the positive number.
I could on the maximum if the down move was bigger than the up move. I saw the minus.
Yeah, it does. There are negative numbers there, so yeah. So this is probably like an earnings surprise or something. And again, it starts on whatever day you want. So, and if you only want to look at like the last 6 months, you can do that. And this is the last 10 months. You can see how maybe it's getting more volatile over the last 6 months or something, or less volatile. But this is basically using historical movements of the underlying. It has nothing to do with volatility. It's only looking at the open, high, low close of the stock or index. And this does use Yahoo data, so you have to use Yahoo symbol. So if you're using an index, notice the Russell has a little caret in front of it. So it has to be in that format. If you just type RUT, it's going to look for a RUT stock at Yahoo, which isn't going to make any sense.
Right. Now, also the thing is that the Yahoo pricing has dividends in adjusted closes. You're using the adjusted close price, not the actual close price, right?
Actually, I think for this, I'm just using the close, but I do have the adjusted close data, so I can tweak it to use that.
Okay, it doesn't make a difference. It's just so folks know one way or the other.
Yeah, maybe I could put a checkbox to use adjusted close versus the actual close.
Include, right? And by the way, because you and I know adjusted close, and most of our senior traders know adjusted close, but not or newer members might not. Why don't you say include dividends or not? Because that's what the include dividends and corporate actions or whatever. Because that's what the adjusted close is.
Right. So if you do this checkbox and refresh it, you'll see the data. This starts on Tuesday and has 3 days, so it's always going to end on a Friday. So if I look at my date calendar, Friday, October 17th, so these are all the Fridays, and there's all the data. So if you want to actually see the numbers, you're free to click on this show data, but to me it's faster, and I don't really need to see the data. I trust it. Then just don't show the data.
Anyway, I look at this, and one of the things that I use the tool for, that after Tom Preston, okay. And by the way, when I say gave me an assignment, this was back because I guess a lot of you guys know. One time, Tom Sosnoff told me I was one of the first 100 clients of Thinkorswim. He looked at my account number and he's like, "Yeah, you were one of our first 100 guys." So back when I would end up calling up, it would usually be either Tom Preston or Sosnoff would pick up the phone. Anyway, when I spoke to Preston about this, what he ended up suggesting that I end up doing was to understand if the ranges were getting bigger or smaller, if things were getting more volatile or less volatile. So I used to end up keeping my spreadsheets updated and go back to this and watch this on a regular basis. If I was putting on trades, because it was very, very important. The thing that Tom's also done for you guys that I don't know if you realize just how critical this was is that he gave you an end date. So for you back testers out there, you can end up using the start date and the end date to see what your ranges are like and go back and saying, this is the way I would have tested it, right? Absolutely fantastic, okay, for back testing.
Well, another thing I'm thinking of adding is like a chart. So instead of showing the data in the table, like graph it, and that's definitely possible to do.
Yeah. The last comment I'll just end up making is that, what we're trying to end up doing is making the website to have more and more specific tools that we think are important to options traders. Now, Tom and I are doing this from our experience, okay? Well, let me rephrase this. Tom and I are thinking about it from our experience. Tom is doing it from his experience, right? Because he's the one who's putting together the tools. But if there are specific things, okay, that you're interested in or you think would end up being good, please, drop us an email. We can discuss it if it makes sense, and if it becomes a valuable tool. We want to be able to end up providing, okay, things that are going to be useful for folks that they can end up doing, analysis on their own. I will end up, okay, looking at the Danger Will Robinson stuff, and I'll try to get you guys the code by next week. That was pretty much it.
There was a comment in the forums about, I forget who it was, they uploaded a spreadsheet with the settlement values for the RUT, and I actually have the settlement data in a database, so I could actually kind of merge that settlement data with my price data and build a tool to basically, so you don't have to update that spreadsheet manually. You just come here, hit a button, and see all the current stuff.
Okay.
So anyway, it's still in beta. I mean, I just coded it up this weekend. I don't think there's any errors, but if you find any, please let me know. And be happy to make any changes if you have any suggestions on how to make it better.
Okay. There's one other question. Charles Cottle, okay, I was asked about that. Charles Cottle was involved in the very, very beginning. I ended up telling folks, this is actually kind of funny. I was a Thinkorswim client before Scott Sheridan worked there full time. For those of you who know the beginning of Thinkorswim, what happened was that Scott stayed on the floor and he traded Tom and Scott's account, right, because they were trading partners for years. And so he continued to end up trading it just in case this little brokerage idea didn't end up working out. He stayed on the floor, and he continued to trade. Charles Cottle ended up starting there also. I don't know if you guys had gotten this, but the very, very early people got a copy of what would later become Charles's book, but it was Coulda, Woulda, Shoulda. It was basically a paperback. They ended up printing, and they used to end up sending it out to their initial clients. Charles's book was brilliant. The challenge was that for any non-heavy duty math guy, it was difficult to follow. It wasn't, one of the things when I ended up starting, I was told, like all floor traders, to go and read Larry McMillan's strategic options and strategic investments. And when I ended up going through that, that was very logical. It went through the trades. Later on, when I went back, and I still got the book, by the way. I still got the paperback, coulda, woulda, shoulda. I went back, and it was interesting because, you know, you could see just how much stuff there was there, but it was difficult. Let me see, does this still work?
Yeah, that's a great book.
Yeah, it was very, very interesting. Okay, how many of you guys knew that, right? Did you see that? It's interesting to see how many of the back doors they took out of the code. Tom, if you go, oh, okay, you're going to make me the presenter? Okay, that's fine. I'll show you this real quick. There's a ton of little crap. This was one of my favorites. What Sosnoff used to end up doing is they used to end up having like pictures of their Christmas party and stuff. So my licenses used to hang there. So the people who were remote, you could always end up signing in. Let me see, where is my share desktop? Now that I show this, I'm sure they'll go and they'll take it out. But, you know, the thing is that if he ever had, like, you know, and it was never confidential stuff. It would be like pictures of the you know, Christmas party, or something like really, really rare, like a picture of Tom Sosnoff without his beret. Okay. If you ended up clicking on these 3 in a row, a little door would open. And, right, up would come pictures, okay, whatever message you wanted to end up having, end up coming up there. It would end up being, you know, just maybe notes to the beta users or things like that, or so. Useless stuff about the system.
A little Easter egg.
Anyway, any other questions?
I think that's it. Just to talk about Charles, if he got anything or not when he left Thinkorswim. I'm not sure how that worked out, but no real questions though.
After Charles left, it was kind of not really talked about. I know nothing. I know nothing about, you know, the circumstances for which he left, you know, good, bad, or indifferent. I just knew that, you know, the next day, you know, once he was gone, we stopped kind of, you know, talking. I didn't know him very well. I only spoke to him, you know, a handful of times, and that was 10 years ago.
Yeah.
Doubt he even remembers me.
All right, everyone. Thanks for joining us. I think that should wrap it up, Jim.
Thank you, guys. And who do we have on this Thursday?
This Thursday, we have Larry Richards from Monte Carlo. He's going to go over the back testing software. Their public beta is starting soon, and then I think they're going to have their initial commercial release next month is the plan. So it should be pretty interesting. And then the week after that, we've got Kerry Given, Dr. Duke from Parkwood Capital. He's going to be teaching about option trading myths. Sounds interesting. So some interesting speakers coming up.
Great. Okay. Thank you very much.
All right. Thanks, everyone.